First thing, rates are lower than they were a few weeks ago, but the market has definitely stalled. Mortgage bonds have kind of found a little bit of a balance, at least temporarily, after last week's rally that was tied to President Trump's comments about having Fannie Mae and Freddie Mac buy mortgage bonds. And since then, rates have really mostly moved sideways, and that just tells us that the market's really waiting for proof. And as always, it's not going to be a straight line down. So until there's kind of clarity on if and how those bond purchases actually happen, it's hard for rates to move much lower from here. And now let's talk about inflation, because that is still the main driver. Rent numbers are continuing to help. New rents are barely rising, and in a lot of the country, they're actually coming down. And this matters because housing costs make up a big chunk of inflation. The problem is really just timing, because official inflation reports do still show rents running hotter than what people are actually paying today. And as those numbers continue to catch up, inflation should continue cooling, and that should help mortgage rates over time. Wages are also slowing. Both people who stayed in their jobs and people who switched jobs saw pay increase less than they've been, and that's another sign that inflation pressure is easing. Slower wage growth usually gives the Fed more room to cut rates too. And the labor market itself is just stuck in this low hire, low fire mode. So basically, very few people are getting laid off, but also very few people are getting hired. So that doesn't create inflation, but it does also not scream strong economic growth. And keep in mind, lower inflation and a weaker economy, especially the labor market being weaker, do tend to help mortgage rates come down. Housing activity did pick up noticeably. We saw new home sales jump, which was helped by the incentives that builders offer, as well as lower rates. But existing home sales also surprised, and that's to the upside, even though it is normally a slower time of the year. Inventory's still really tight, meaning there's fewer homes available than in a normal market. And that kind of combination of improving demand as well as limited supply is why prices are still holding up and are likely to rise if rates continue to come down a little lower. And this just means appreciation for homeowners, and that should help people waiting really get off the fence. Just let me know if you need a cost of waiting analysis. Mortgage activity is up, especially refinances, and that's also important because for the first time in years, more mortgages are now above 6% than below 3%, and that just means there's some demand, at least pent-up demand for refinances, even if, a refi doesn't always make sense long term. And this is really just a great time to educate your clients. If you want, I do also have an article explaining why people refinance, even if it might cost more in the long term. I have a short video breaking down the true cost of refinancing, as well as a free refi watch list that I can brand for you to share with your database. And that's just to help you add value and stay top of mind. Behind the scenes, there is also kind of a growing uncertainty around the Fed itself. There's the investigation you've probably heard about involving Fed Chair Powell, and that just adds noise and kind of more unpredictability. Powell does say he's going to finish his term, but markets are obviously thinking ahead to who will be the new Fed chair and expecting a potentially more rate-friendly future as a result. And that's just one reason long-term rate expectations have stayed lower. But have a great weekend, and I'll see you next Friday.